Good evening, everyone. I hope you've had a wonderful weekend. I have a backlog of questions, so I'm going to try and get through them over the next week or two. So the first question that I have been asked quite a few times is, what is an SPV? An SPV is a special purpose vehicle. It is a limited company that is created for the sole purpose of one action, be it to own a property or for a particular transaction or something of that nature. With regard to property, if you are forming an SPV, then you need to actually add the correct SIC code before you can, for example, get a mortgage to buy property. There are generally 4 SIC codes for SPVs. First one is 68100, which is for buying and selling your own property. Then there is 68209 for the letting and operation of your own or leased property. Then 68320, which is for the management of property, and 68310, which is for estate agencies. Now, with regards to an SPV for the purpose of buying and owning a property, be it to buy a property to renovate it and rent it out, or just purely for renting, or you're going to buy a property and renovate it and then perhaps sell on the SPV, there are many advantages. Those of you who are already landlords will be aware of Section 24, which has taken many landlords from a profit to a loss because of the way tax is calculated on the entire rate, and basically you cannot claim your interest against your expenses, so you're just taxed on the whole lot as if it were a profit, whereas if the property is within a company, then you can claim all your expenses as normal. There are other advantages as well. For example, if you have young children and you'd like to take advantage of their income tax allowance, bear in mind that children have the same tax-free income allowance as adults. However, children can't own a share of a property, not until they're 18, but they are allowed to own shares in a company. So there are ways where you can actually ensure that you use your children's tax-free allowance, but you, as always, need to get professional advice from an accountant where this goes. If you're buying a property that you're going to renovate that you believe may be of interest to an investor at some point in the future, once again, it is better in many cases to buy it as within an SPV, especially if you are buying a property that is derelict and therefore would be exempt from the 3% stamp duty surcharge, and it is then not charged on the normal stamp duty rate. It is charged on the non-residential stamp duty rate, which can save you quite a bit of money. Plus, when you actually complete the project, the investor will be buying the company, not the property, meaning that they won't have to pay stamp duty either, because they're not buying a property. So there are lots of advantages, but there can be some disadvantages because of the way companies are taxed. So you do need to get the advice from a professional. It's not my place to be giving you that sort of advice because I'm not qualified to do so. And basically, in a nutshell, that's what an SPV is and how it works. If you're looking at getting into property and building a portfolio, it's definitely worth considering. Even if you're building up a portfolio without the tax advantages, SPVs are fantastic for what's called ring fencing property. So if you're, say, aiming to buy 5 or 6 different properties, if each one is owned by an SPV and each SPV is owned by one umbrella company, then you are also able to transfer funds between each company tax-free. There was a test case with regards to capital gains tax if you want to incorporate a property into an SPV, where In this test case, it was permitted for the landlord to defer capital gains tax when incorporating a property, because if you have an existing property and you want to incorporate it into an SPV, you don't just transfer it. It is a sale and a purchase. Capital gains has to be paid, stamp duty has to be paid. So they knew what they were doing when they dropped Section 24 on everyone, because they knew that many existing landlords, it wouldn't be feasible for them to move over. So definitely worth looking into deferring capital gains, because that can make a big difference. And when properties are ring fenced, that also not only ensures that if anything goes wrong with one property, it won't affect the other. It can also affect you in terms of your buy-to-let mortgages, because buy-to-let mortgages are subjected to what's called a stress test. If you have 6 properties, say, on your name, and one of them fails the stress test, which many are now because interest rates from where they were have gone up so much, and the stress test, which is basically the lender calculating that whatever your applicable interest that you are charged, say annually, or as a percentage, whichever way you want to work it, they 125% of your interest rate the current interest rate must be covered by the rent. Well, obviously, not only have interest rates gone up, which means that 125% has risen significantly, but there are many lenders who have increased that stress test to as much as 140%. So if you have several properties, and even if one of those properties fails a stress test, it could actually endanger your ability to refix any of the others and get different deals. Whereas if all 6 were all within independent SPVs, each one is, if you like, a body in its own right and is not affected by the others. So there are definitely advantages worth looking for. But as I said before, please get professional advice before you do anything. I hope that helps. I'll be back with the response to more of your questions, hopefully through the week, as and when I get time. And as always, if you have any questions with anything to do with property, please feel free to get in touch anytime, and I'll see you in the next video.